Welcome all of you all for the mock paper discussion, SL3 Corporate Taxation. The main target here is to, within a shorter period of time, discuss the SL3 mock paper. This is actually, you have done this paper in the online platform. Then that paper we are going to discuss the answers and what are the explanation you all need to do a good the two-phase for the actual exam in very well. Then this discussion is helpful for you all. Okay, then that is the main target, and we will go ahead with the mock paper discussion. Okay, now in the mock paper discussion, I am starting with your 50 marks question, which is the section 2 question, section 2 question 3. That is the main target, the first main target. In that, I am starting from your company taxation question. When it comes to company taxation question, all of you all know this is based on the precedent given. Now, for the mock exam, the separate precedent has provided. The paper or your unseen is prepared based on that precedent. Now, we will go through the all relevant areas in that precedent, which is the relevant for the mock exam, not for your actual exam. Then we will go through the precedent, very specific points relevant to this the question, and we will go the question 3 part A, B, C and going forward. Okay. Then again, even when doing the pilot paper discussion, I have done same thing, but I need again very close, since you all very close to the actual examination, these points are really important for your actual examination. Why I am telling like that? Because in this, the online platform, in the online exam, you have to do 3 things. You have to read the paper, you have to think, and you have to type. Think, read and write in, you all expert, but in this platform you have to read the question and you have to think the answer format and everything, and then you have to type. Then in that contest, this is very important for you to read in the question very carefully. Even the physical exam, it's yes, but here since it's the platform is different, you should have this additional concentration on this the exam paper. Okay, then this is the base information. This again resident company taxation, which is in your syllabus, 30% syllabus area, all of you all know this. Then this is a quick summary for you all. Then what is the testable year of assessment? This is the year of assessment 1920, again without proposed changes. I am repeating, your year of assessment is 1920. For income tax, it is not for the income tax, even the other taxes, it is without proposed changes. Please keep that in mind. That's very important. In this the mock paper discussion, one of the main thing I need to tell you all again is your paper is without proposed changes. Okay. Then the second one is where is in this question in the paper, this is section 2 question 3 part A. What now we are going to do. Okay. Then the third one, basis of the question, it's a based on common precedent. For this mock paper discussion or this mock paper, you all having a precedent, but for the actual examination, a common precedent already given. Okay. Then based on the common precedent issued before the exam, unseen question will be provided. Okay, you are well prepared. Almost all of you all now very well prepared. Then marks allocation, it's 25 marks given in the question, and time allocation 45 minutes. Even I have calculated strictly for the 3 hours, but in the online platform you all receiving 3 hours and 30 minutes to write or type, and another 15 minutes as a reading time. I have ignored that additional 30 minutes and I am taking this as a normal way. Okay. Then This is the analysis of pre-scene information, which mock paper discussion, which is given in the pre-scene for the mock paper. The name of the company, Diamond Private Limited, DPL, and principal business activities. There are the principal business activities given. We will see one by one. I am again asking why the importance of the principal business activity: to know the income tax rate to apply on taxable income, and to identify expenses incurred for the production of income. Then for all these things, this is really important. Then we will go through what is the principal business activities. Then this is a family-owned dairy products manufacturing company incorporated in Sri Lanka. Okay, it's a dairy product manufacturing organization. This is family-owned. Then, and this is private limited, not a quoted public company. Then DPL specializes in milk processing and manufacturing of dairy products. They are processing milk and manufacturing of dairy products. We don't know how they are getting milk. Are they bio? Are they having own cattle? We will see. Then next, all this information I have extracted from the common pre-scene. 20 years ago, Mr. Wilson is co-founder of this organization, began processing the fresh milk of his family farm. That information has provided. Family farm, they have a family farm to make a small range of dairy products, including canned milk and yogurt. Okay. Then next one, acquired more dairy cattle, husbandry, and building new production facilities. In recent 10 years, they have done this part. After that, next point, DPL produces all kinds of dairy products like fresh milk, milk powder, yogurt, butter, and ice cream. These are the dairy products. Then the company sells its products under Diamond Gold brand name. Up to now, under the discussion of the principal business activity, they are in the milk processing industry, collecting milk from their own farm, agro farming. Then they are processing milk, and the milk processing goes to yogurt, ice cream, milk powder, likewise under their own brand name. I think that part is clear. Then we will go in when analyzing the pre-scene. The latter part of the pre-scene, actually page 6 of the pre-scene, it's separately given the structural change of the organization. I thought it's important for you when doing the question. Investments with other entities, this I have taken from the page 6 of the pre-scene. In that, rather than going for the part A, the part B of this I need to highlight. On 1st April 2019, as a strategic decision on expansion, its market share in the dairy industry, DPL acquired 70% of equity interest of the CADA Limited or CADA, which is a company specialized in cheese and butter products. Now currently we are not manufacturing cheese and butter, but we have acquired a subsidiary now. We have invested 70%, that means more than 50% we have invested. This is now our associated undertaking under the Inland Revenue Act. Then it is in a separate industry. Paying cash of rupees 570 million on 1st April 2019, the retained earnings and other components of that new acquired company has given. And if I have shipped to A now, on 1st April 2018, DPL acquired 40% of the equity interest of Green Limited, which is a company engaged in providing technical and IT support for manufacturing business. Now when looking at that acquisition, which is drastically different from the business what we are doing currently. Okay. Now these are the very short summary of the information which I have taken from the pre-scene as a support for your question, as a support for your company taxation question. Okay. Then we will go for the question paper Then we will discuss one by one what are the questions asked from the students. Okay, this is your paper. Then this is section 2, question 3 based on the common precedent. Now as my Patrice, before reading the entire information of the question, now I am going to the requirement of the question. What is the requirement of the question? We will see. It's for the 25 marks. Assess the balance income tax payable by DPL if any in respect of year of assessment 1920. For the year of assessment 1920, balance income tax payable. Now when computing balance income tax payable, all of you all know, the first you have to compute business income, secondly investment income, thirdly if any relevant other income, 3 and the assessable income relevant to all these 3. After that, from that assessable income, if there are qualifying payments, you should need to deduct that qualifying payments under section 52 and the 5th schedule, then arriving of the taxable income and applying relevant income tax rates. Is that all? No. When doing company taxation question, you should know about the case law provisions and it may link to the business decision making, all these things. Okay. Even discussing the prior discussions in pilot paper, we have discussed all these things. Now we will straight away go to the question. Then this is the question, and first I must say I have done 2 changes to the paper. It is different to the paper which you all received. It has done with the authorities. Then with this I will communicate that 2 changes also. Okay. Then question 3 based on the common precedent. In addition to the information provided in the common precedent in connected with Diamond Private Limited DPL, you are provided the following additional information for the year ended 31st March 2020. Then additional details extracted from the unaudited income statement of DPL for the year ended 31st March 2020 are as follows. The revenue is given, cost of sales, gross profit, other operating income, administration expenses, selling and distribution, all separate notes given, and finance income separately given, financial expenses, it's separately given, then profit before income tax, what is your base figure to compute the business income. Now as previously I have done with the discussion of the question, I am going to the answer. I have developed it in the Excel. Then we will see entire adjustments with the when reading the question, and we will refer to the answer. Okay. Now as the starting part of this, you all having now I am starting with the business income part of it. Diamond Private Limited, the particular TIN number, please, I think now all of you are familiar with this format very well, I guess. Then therefore, please follow these things. It's very important when doing online examination. TIN and schedules to tax computation for the year of assessment 1920. Schedule 1, computation of assessable income from business. In that, from the question I have extracted net profit before taxation. This is, I have taken it as rupees thousands. Then in the question it is 192,405. Then that has obtained. After that there is income tax expense and the profit for the year. Then the separate notes, additional notes on revenue. The 2 separate revenue lines are given. One is sale of dairy and other manufactured products, 1.1 billions. It's 1,140,000 likewise. sale of fresh fruits and vegetables in agro division, it's 52 million. Why these two kind of revenue? Even these are dairy products, DPL, but it has divided to two separate revenue lines. Why? To see it is why we will go for the analysis of the taxable or analysis of the revenue of this organization. Now, this is actually additional note for you to capture what is the income tax rate applicable for this company. Now, in the agricultural industry, agricultural business has defined in section 195 is the first word in the section 195 definition of the Inland Revenue Act. Then in that very clearly the definition has given. In that definition mostly covered the raw part, the raw milk likewise. Then this is the manufacturing, there is a process. Then therefore we need to look at the revenue breakdown according to the predominantly concept. Now you all know under first schedule we can apply for the agricultural business reduced tax rate of 14% if the total turnover, the agricultural business turnover, the turnover from agricultural business is 80% or more from the total turnover. Now we are going to see that test. Okay. Then analysis of agricultural income. Now I will go through step by step how I have applied the rate. As per information provided in note 1 revenue, the entire revenue has received from agricultural business by selling of vegetables and processing of raw milk, dairy products. Therefore, to check the applicable tax rate, now it's given, it's normally it has given the agricultural business, one part for the selling of vegetables and second part of the second part is the dairy products. Now we need to look at agricultural income. Now for look at agricultural income, it's very important to look at the definition of section 195. Agricultural business means the business of producing agricultural, horticultural or any animal produce and includes an undertaking for the purpose of rearing livestock or poultry. This is talking about animal produce. The animal produce is from cow, you all take in milk, the raw milk without any process. Then that is the animal produce. But what this company is doing? They are collecting raw milk and processing into various products, yogurts, ice cream, fresh milk like that. Then according to this definition, such process has not covered in here. Therefore, for the dairy products part of that, the income received from dairy products, we are not in a position to apply the reduced tax rate of the 14%. We will see. Now looking at the total turnover agricultural income divided by total income, the agricultural income I have taken 52 million, which is selling of the growth vegetable. We are having the crop, then we have from the vegetables without any process, we are selling that vegetables, then it is agricultural part of it, then it's only 2.61 of the, if we seen it under predominantly concept. Okay, then the applicable tax rate anyway for the company is 28%. Why? The dairy products are not in the 2019-20 without proposed changes, then the rate is 28%. But I need to highlight this part also, additional explanation. This is actually not relevant for the examination, but this agricultural part has tested in the mock paper. I thought it's good to explain this one also, because you are not stopping from the paper, but you all are in the students in the tax field. Then here as per the paper notice, this PNIT 2020-03, which is revised, issued on the 8th April 2020. According to this, the agro farming part is exempted. That means that the growing of vegetables and selling that vegetables, it is exempted, and the agro processing part, that means the dairy part, is the liable at the rate of 14%. It has the exemption has given from 1st April 2019, and the for the agro processing 14% has given from the 1st January 2020. This is not relevant for your examination, but I must highlight this since this industry there is a change. Okay, then I think everything clear on application of the tax rate. Now again we will go for the paper. In the paper, now revenue we have sorted out. Then other income, disposal loss from, profit loss from disposal of PPE in the other income. When looking at the figure, we can see it is a loss, 28 million loss. And taking 5 minutes, I will just glance through the figures and we will go for the adjustments. Anyway, there is a disposal loss, it is accounting loss. You should not consider it for the tax purpose. Now it has deducted from the profit before tax. You should need to add back that. Second one, gains on realization on quoted public company shares, which is 10 million. It is not part of the business income. It should be eliminated from the business income. That gain is in your profit before tax. Now you should eliminate it from the business income and it should goes to investment income. Even under investment income under section 7, it will not taxable because it is exempted. Then dividend income net 8.6, again investment income, same treatment, it is a final withholding payment. And interest income from fixed deposit, it has given gross. We will see how we are going to capture this in the answer. Interest income from treasury bills, investment made during the year, 68 million. There is a huge amount of sundry income, 270 million. Okay. Then extract from administration and selling and distribution expenses, salaries and wages, entertainment anyway disallow, donation and gift disallow when arriving into business income, but we need to look at whether there are qualifying donations. Fines and penalties disallowed if it is under section 10, if it is payable or paid to the government, then we need to look at that in the additional notes. Allowance paid to managerial staff, we will see. Operating lease rentals on motor lorries, provision for gratuity, disallow anyway. Advertising, we need to look at the nature. Depreciation under section 10 anyway disallow. Amortization of intangible asset, it's disallow. Under section 10, traveling, we need to look at the nature. Foreign traveling, again we need to look at the nature. Provision for impairment, disallow, any provision disallow. Then finance cost, long term loan interest, short term loan interest, overdraft interest, finance leases on 5 motor lorries. Then we need to look at what are the finance costs we are taking under section 18 restriction and what are the finance costs we need to look at under for an example finance leases. We need to look at lease agreement entered in which period to us to apply the adjustment. Now we will see one by one from the adjustments. Okay. Then actually in your paper also start with the adjustment, then you are not missing anything. Read the adjustment, go for relevant expense or income category, finish up and come to the next one. Okay. Estimated attributable cost charged to income statement for cultivation and sale of fresh fruits and vegetables in agro division is rupees 31.2 million. Why the examiner has given this part for the mock exam? Actually, this is after the proposed change. The agro product, that's mean agro farming part has exempted from 1st April 2019, and what the examiner has given, the expenses relevant to that part separately given, it's for you to take it out separately, but this adjustment I am not going to do because this is with the proposed changes, then I am not going to touch this. But I have explained the meaning why it has included. Okay, this is proposed change paper notice PNIT 2020-03 revised, issued on 20th, this is 8th April 2020, which is para 4 in that paper notice. It's a Roman 1, it's very clearly given the sale of produce of an undertaking for agro farming of such person without subjecting such produce to any process, it's very clearly given, of production of manufacturer with effect from 1st April 2019, but don't worry about this, since the adjustment has given, I have discussed this. Okay. Then third one, but it's better to know. Then third one, cost of sale include stock provision made for damaged raw materials and half finished good stock of rupees 12.6 million due to severe storm happened in August 2019. There is inventory provision. All of you all know the inventory provision should be disallowed when arriving into business income. We will see one by one. We have discussed on the profit, and then stock provision made for damaged raw material is disallowable. What's the section? Section 10 subsection 1b, it's a Roman 8. Again I am telling, I am repeating these sections for you, but at least now obviously at the company taxation question you can write all these subsections. Why? You are allowed to have these all the relevant open book referential, other also any other reference material at the examination. Okay. Then we will go for the next adjustment quickly. In that the fourth one, on 20th December 2019, DPL disposed 2 pool motor vehicles which use only for business travelling and transport of goods. The details of vehicles are as follows: motor car and motor lorry. When looking at these two assets, motor car, it's purchased in 2018-19. You should know motor car is not a commercial vehicle. It has not covered under the section 16 and the 4th schedule both. Then any gain or loss we cannot consider for the tax purpose. And motor lorry which acquired prior to 1st April 2018, this two acquired in 2015-16 and cost is given and the sale proceed is given. Okay. Now we will see what are the adjustment which we need to do on this, and again in the adjustment 5 it's again given accounting net loss. There was a 28 million accounting net loss. Accounting net loss from disposal of PPE has been declared under other income after netting off the accounting profit received from the disposal of motor vehicles against the total loss estimated for destroying part of the factory roof, machinery and processing equipment in August 2019 when a severe storm occurred. Accounting profit on disposal of motor car rupees 3 million, motor lorry is rupees 5 million. Now it's again linked to this one. What is telling? Accounting net loss. We have seen that after netting off this 3 million and 5 million of accounting profit, netting off with what? It's given netting off with accounting profit received from disposal of motor vehicles against, see the word, total loss estimated to destroyed part of the roof. Is that actually incurred? No. Even in the disposal schedule, is it given built-in or a roof, whatever that permanent nature of a structure has the disposed? No. What this has given? Total loss estimated. It's an estimated figure. Read the question very carefully. Okay? The way of reading the question is the eye-opener for you. Now, what we can do? There is a 28 million other income. You can do two things. Exactly, straight away take this 28 million and it's add back to the profit before tax because it's a loss. Now it has deducted from PBT the all three amounts, which is to profit of the disposal of vehicles and the one thing what the destroyed part of the building and all, then you can eliminate this first, or else you can calculate the gross amount. I have gone through the second method for you to give a better understanding on this. We will go to that calculation and we will see. See, accounting loss from disposal of PPE is 28 million. It has given. Okay. Now, total loss estimated for destroyed part of the factory roof and processing equipment 28 million has received after netting off these two. Then what I have done, I have taken without netting off what is the estimated loss of the destroyed that particular, the estimated loss of that factory roof, machinery and processing equipment. It's 36 million. Then I have add back that 36 million to the computation and accounting profit on disposal of motor car. It is in the profit before tax. We cannot tax it. We need to go through what is the relevant provision in the tax law. Then therefore that profit I have eliminated from the PBT. Then accounting profit on disposal of motor lorry. That also we need to compute the what is the assessable charge or a balancing allowance. Therefore, that profit I have the separated or removed from the profit before tax. Now, the net impact of 36 million minus 8 million is again 28 million. No harm. What I have done, first thing I analyze the adjustment and look at what is this. It is estimated loss. I have taken estimated loss separately and disposal profit separately and done the adjustment. Okay. Or else you can do that the elimination of or adding back, not elimination, actually add back of 28 million you can do, but without that, by analyzing this part, it's very clear, the adjustment is very clear. Okay. Then I am straight away go for the answer since I have discussed the question, that part, computation of assessable charge or balancing allowance on asset disposal. In that, the motor car, particularly given motor car purchase in 2018-19, then sale proceed given in the question 17 million and the tax written down value, we need to look at what is the tax written down value, only the cost. Do we have a tax written down value on this? No. For the travelling purpose motor vehicles, it is out of scope of the Inland Revenue Act number 24 of 2017, that gain, disposal gain or loss, it is out of scope. All of you all know up to now these things. Then therefore, we need to deduct the cost from there and it is, my note is capital allowance not applicable since this is travelling purpose motor vehicle. Okay. Then the 17 million minus 14 million gain is 3 million. The gain excluded from IR Act number 24 of 2017, I have explained the reason. This is not covered, this is not a depreciable asset, then this is not covered in section 16 and 4th schedule of the Act. Okay, done. Then second disposal, now we need, on behalf of the disposal of motor car, you need not to do any adjustment. Okay, it is not taxable. The profit we have eliminated, accounting profit we have eliminated from the profit before tax, then calculated tax for the purpose we have, there is a 3,000 or rather 3 million of the profit, that profit we are not going to tax. Okay. Then next part, motor lorry purchased in 2015-16, sale proceed given as the 9 million, and we need to look at the what is the tax written down value. Cost is 10 million. Then we need to look at what is the cumulative capital allowances claim. These are again under the transitional provisions. The assets acquired prior to 1st April 2018. Okay. Then cumulative capital allowances claim, this has acquired in 2015-16, then 15-16, 16-17, 17-18, 18-19, we are in the 19-20. The year of disposal, no capital allowances, then only 4 year of assessments. In that, this is motor lorry under all that. For the motor vehicles other than travelling purpose motor vehicle, the capital allowance or a depreciation allowance rate is 20% now for the 10,000 into 20% in 4 years. Then the cumulative capital allowances claim on the cost is 8 million. Then the tax written down value is 2 million. 9 million minus 2 million, there is a assessable charge or taxable profit on disposal of motor lorry 7 million, 7,000, since we have taken the answer in 1,000. Okay, I think these two adjustment very clear. Okay, same adjustment we have done in the pilot paper also, then you all are so practice on this. Then we will go for the question paper again, see what is the next adjustment. Now here other income, profit loss from disposal of PPE we have done. We have done in your exam, if you can, now the issues from the student, they cannot remember this adjustment I have done or not, then therefore at least mark it in a separate color, red or whatever. When you done that adjustment, mark it and finish off. Okay. Then the next adjustment, adjustment number 6, it is to be assumed that the market value of the shares as at 30th September 2017, which was disposed during the year, was equivalent to the actual cost of those shares. Why this has given, all of you all know, under the Inland Revenue Act section 203 subsection 4, under transitional provisions adjustment, if the assets acquired, if the investment asset acquired prior to 30th September 2017, then we need to do the valuation, and at the date of 30th September 2017, we need to do the valuation on that asset. That's why examiner has given no, the market value and the market value of the share is equal to as at 30th September 2017. The adjustment is very easy. Then here, that's why in the within bracket I have given the explanation, investment asset disposal equal consideration minus cost of the asset. Cost of the asset, if asset is acquired prior to 30th September 2017, should take the valuation as at 30th September 2017. This is a transitional provision adjustment, section 203 subsection 4. Okay, done. Then what is this given in the paper? It is under other income. Under other income, gain on realization of quoted public company shares 10 million. We need to eliminate it from the business income. Gain on realization of quoted public company shares considered as investment income under section 7. We have eliminated, and again I am in this time I am going for the investment income also. Diamond Private Limited, TIN, Schedules to Tax Computation for the year of assessment 1920, Schedule 2, computation of the assessable income from investment. Then here, gain on realization of investment asset, it is shares, gain on realization of quoted public company shares. This is exempted income under third schedule, item H. Then no adjustment. Only thing we have to do is eliminate from the business income. Okay, then we will go for the next adjustment in the paper. Sundry income rupees 250 million represent the money received from a dairy products manufacturing competitor in Eastern Province for not starting a business. This is a one change made for its I think your original paper it is as 5 years, but it has changed to 3 years. If we have used the 5 years, we are ended up with the business loss. Therefore, it has changed to 3 years. Okay, 3 years period starting from financial year 2019-20 and balance 20,141,000 consists of compensation received from insurance company for the destroyed stock of raw materials, half finished goods and finished goods due to severe storm happened in August 2019, which it seems to be that storm has done a lot of damages to this dairy company. Okay, now see what is this sundry income, 250 million. Now we will see what is the amount given in the paper. The amount given in the paper as sundry income is 270 141. See the amount, it is the 270,141. The breakup is very clearly given. The two component of this is 250 million of this, and the second part is 20,141. This is the breakup. It is given in the paper. What is this? This is insurance claim. This is insurance claim. Insurance claim on what? On damage inventory. Then this is on damage inventory. If this is on damage inventory, then what is this? This is income which received on damage inventory. This is effectively connected to the business. This income is effectively connected to the business. Therefore, this insurance claim is part and parcel of your business income under section 6 subsection 2G. Therefore, we need not to do any adjustment on this regard. Okay, that's first explanation on this. We will go for next explanation. This is 250 million. This 250 million, see what is the reason of this receiving this amount. What is the reason of receiving this 250 million? It is manufacturing received from manufacturing competitor in Eastern Province, not start in a business. We are restricting our capacity to conduct a business. The restriction of capacity to conduct the business. What is this? This is part of the business income under section 6. Now next question. Okay, now is this entire 250 million is part of my business income in this year of assessment? Is this entire 250 million? Then you have to look at the content of the question. The question, it is given this has received for 3 years. This has received for 3 years. If this has received for the 3 years, now we are doing the computation of 2019-20. Including 19-20, 3 years. Then this is applicable for another 2 years. Then my last question to you. Then income applicable to another 2 years. Can we take it under this year and pay tax? No. We have to eliminate from this 250 million divided by 3 into 2, we need to eliminate from the business income, and in 2020-21 and 21-22 it will be tax under business income, and this year only the amount received on behalf of restricting capacity to conduct the business is part of the business income. Okay, I think it's clear. We will go for that adjustment in the Excel answer sheet. Here, compensation received from insurance company for the destroyed stock of raw material, half finished good. See, no adjustment required, and this kind of things. What is my kind request from the students? Please write the reason. Compensation received from insurance company for destroying stock of raw materials, half finished good, blah blah, finish off. Don't do that. Write your answer, no adjustment required. Why? This is part of the business income, and if you know, write the particular section. Write the particular section. Okay, done, that part done. Then we will go for sundry income adjustment. Sundry income, accepting the offer of competitor. We can accept, but how it going to be taxed? Total income received, estimate. Now again, you have to think little bit. Here also put the assumption, and my next guideline to you all, if anything is doubt to you all, please write your assumptions. Anikalamai, these assumptions cannot be the hypothetical, it should be hypothetical. Anyway, it should not be the rocket science. You are doing a tax paper. Then that assumption should be relevant to the particular tax section, particular common sense thing likewise. Okay. Then here the examiner has not given what is the portion relevant for the next year and the after that year. Then as a human you can think, okay, we can equally distribute this for the balance 2 years. Okay. Are you going to put in it your mind and just write the answer? No, you should type it. You should type your assumption in your answer. Please write, not only for this part of the question, VAT, non-resident taxation, anything. If you think it is relevant, write your assumptions. Okay. Then sundry income, accepting offer of competitor, total income received, estimate from business income, since total income not relevant to year of assessment 19-20, we will take it as we will eliminate that part. First we have eliminated the insurance claim, done. Then we have separately taken sundry income. I have eliminated the entire part first. Then one adjustment done. The second adjustment, I have taken part relevant to my year of assessment. Or else you can, without eliminating this 250 million straight away, what you can do, you can eliminate 250 million divided by 3 into 2 figure, you can eliminate. Whatever method, whatever convenient, please do. Okay. Then sundry income, accepting offer of competitor, part of the business income. Please write these things. As per section 6 subsection 2e, this in the inclusions of business income, this extract wording is given. Highly testable, I don't know. Then amounts derived as consideration for accepting a restriction on the capacity to conduct the business, relevant for 2019-20. I have taken it 250 million divided by 3. What is relevant for my year is 83,333. Then net of this 250 million minus 83,333, which I have given separately. Assume that received equally for 3 years, then the net is eliminated. Okay, I think that adjustment is very clear. Then next question in the paper, out of total amount of allowance paid to managerial staff amounting to rupees 23.8 has not been considered for PAYE tax purposes. The balance amount has been paid after 1st January 2020 where consent of the employees not received by the company for deduction of APIT. What is this pay and APIT? Again, this is proposed change. Up to 31st December 2019, it was pay as you earn tax. Now is advanced personal income tax. Again, it's in the proposed change paper notice. I am not going to discuss that part, but we will do the relevant adjustment. Now, for the entire 23.8 million has not considered for the pay purpose, but the rest of the part the examiner has given. For the rest of the part employee had not given the consent. Then again, for your knowledge purpose, I am telling this. After first not after, with effective from 1st January 2020, with effective from 1st January 2020, the advanced personal income tax shall be deducted only if employee has given the consent to the employer to deduct. If not, that employee shall pay individual taxes. It's a separate story. Don't mix this with this paper and your actual examination. Okay. Then it has given 23.8 million has not been considered for pay tax purposes. Under section 10 subsection 2, this should be disallowable. We will go for that adjustment and see allowance paid to managerial staff, PAYE tax has not been deducted. Disallow section 10 subsection 2, which is any payment, if it is it shall deduct withholding tax, but if it is not deducted then remitted to IRD, then it should be disallowed. Under section 10 subsection 2, then it's 23.8, 23,800, it should be disallowed. Done. Then next adjustment, operating lease renters consist of payment made to vehicle supplier who provided motor lorries with coal room to transport dairy products with drivers. With the refrigerators, there are motor lorries. Then for that we have paid the operating lease renters. WST has not deducted, and it is we have hired these vehicles with drivers. This is operating lease. Since we come to this adjustment, I will explain that I think now as per accounting standards there are no operating or finance leases, then please have a mind of that. There are right of use assets also. Then for that right of use asset, if it is now I am not talking about this, if it's same as the finance lease thing. Now we are having the right of use asset and the earlier finance lease, that's mean finance lease agreement entered first prior to 1st 4/2018 we are having that kind of adjustment, and after 1st April 2018 we are having that kind of adjustment which we are providing capital allowances, and we are having right of use assets in the right of use asset also in your financial statements. Okay. Now since this has given the operating lease rentals which vehicles hired from other party with driver, and it's for operating lease rental, WHT has not deducted. In the rent definition in section 195 it has given any kind of rent we have to deduct WHT, but particular ruling has issued in the ruling has issued in IRD, in that it's clear if the particular conditions are satisfied then no need to deduct WHT. We will see this. Operating lease rentals on heavy the motor lorries used for transportation, it is allowable deduction. It is for transportation of dairies, it is allowable deduction under section 11. Then non-deduction of WHT is not applicable due to provision of transportation. It is the operating lease renter, it is paying for the transportation of dairy products. There are conditions as per the public ruling number PRIT 2018-02 issued on 2nd May 2019, since driver and fuel is provided by the vehicle owner of respective vehicle remains in the possession of the owner. This is considered as provision of transport service provided by the resident individual, and this is not subject to the withholding tax. Therefore, this is production of income. Then this ruling part is just for your information, but then other this ruling part also, if you can remember, it's good. But this is incurred for the production of income, since this is transportation, withholding tax is not applicable. We will go for the next part of the question. Then gratuity paid during the year of assessment 2018-19 was LKR 12.2 million. We will see what is the gratuity provision. Gratuity provision is provision for gratuity 14,150,000 is there, and gratuity payment is there. Anyway, all of you all know this. Gratuity payment is allowable deduction. The provision is disallow. Actual incurred, actual utilization is allowable deduction. Where we are taking this in the financial position gratuity note, it is there, the payment of gratuity. Then from that we have to extract it and we need to eliminate. In the question this has straight away given. Then gratuity provision we need to disallow. We will go that part when doing the other respective adjustments. Then according to the statement of financial position prepared for the year ended 31st March 31st March 2019, the following capital assets are available with the company which is entitled to claim the allowance for depreciation or capital allowance for the year of assessment 19-20. Why it's given as 31st March 2019? That's mean opening asset base, okay, opening asset base, and this the following capital assets are available with the company. It is entitled to claim capital allowances even in 2019-20. That means there is no fully capital allowances given assets, and the disposals are adjusted. We need to put the assumption disposals are adjusted. Machineries 88 million purchased in 2018-19. Then this is dairy products. Then machinery is essential depreciable asset 18-19. It is number of years 5. Motor lorries, finance lease, see it has acquired in 2007, not acquired, lease agreement entered in the year of assessment 2017-18. Then thereby it is the lease agreement entered prior to 1st April 2018, the separate adjustment. Then motor cars, it's 12 million, that 17-18, even under the earlier Act number 10 of 2000, Act number 10 of 2006, even under that Act we have not provided capital allowances for motor cars. Building 160 million 18-19, that means for the building what is the number of years for the capital allowances? 20 years. Office equipment 10 million 18-19, then again 5 years. Computer 6 million acquired in this year 19-20, again 5 years. Intangible assets 35 million acquired in this year 2019-20. What is the provision for the intangible asset as per the 4th schedule? If the actual useful lifetime has given, we shall go for the actual useful lifetime, and if the actual useful lifetime has not given, the lifetime given in the 4th schedule, okay. Then and again actual useful lifetime is the indefinite, even the useful lifetime given in the 4th schedule. Then intangible assets consists of the brand name Mahavali acquired for the 10-year period. Here actual useful lifetime has given 10-year period by the DPL from Mahavali Authority to manufacturing of yogurts. Then we can provide capital allowances on the 10 years, number of years are 10. Very easy adjustment and definite adjustment in your paper. Then we will go for that adjustment. Capital allowances on section 16, 4th schedule to the Act and Transitional Provision Gazette, assume that disposals are adjusted. The two disposals made, motor car and motor lorry, because that information is from the cost, these are eliminated or has not provided, then write your assumption, assume that disposals are adjusted. Then machineries purchased in 2018-19, 5 years, cost divided by number of years. Then motor lorries, finance leases in 2017-18, leasing allowance shall claim as per transitional provisions. Third one, motor car, not eligible for capital allowances since travelling purpose motor vehicle. Fourth one, buildings acquired in 2018-19, 160 million, it's 20 years. The 8 million is the capital allowance. Office equipment purchased in 2018-19, 10 million divided by it's 5 years, 2 million. Computers purchased in 19-20, 6 million, it's divided by 5 years, 1.2. Intangible asset is a brand name. Since the actual useful lifetime has provided allowance for depreciation computed on actual lifetime as per the 4th schedule to Act, thereby 35 million divided by 10 years, capital allowance is 3.5 million. Okay, all the capital allowances other than leasing allowance we have considered and done. Okay, then we will go for paper. What are the next adjustment? Next adjustment, travelling allowances includes rupees 23.8 paid to non-executive employees, which is considered as not liable for pay for tax purposes as their employment income below rupees 100,000 per month up to 31st December 2019. And executive staff who are below 250,000 after 1st January 2020. The balance consists of official travelling expense. Again, this the purple colored part, it is from the proposed changes. Prior to 31st December 2019, the relevant salary or remuneration for PAYE tax is the above 100,000. But after that, with effective from 1st January 2020, for the APIT is 250,000. It is for your information, but it is actual examination. This kind of things is not testing. Then this is 23.8, all is allowable expenditure. Then no worries on this. Travelling allowance, pay tax not deducted because it's below the pay threshold. Allowable deduction, since all employees are below the threshold of PAYE tax, deduction done. Okay, no adjustment required. We will go for the next one in the paper. Foreign travelling. Foreign travelling cost incurred to visit Europe and USA for participation of exhibitions and trade fair to acquire foreign market opportunities. Since the tour was successful, the company received new business opportunities to enter Europe and USA market in the financial year 2021. Now, anyway, this is a foreign travelling incurred for the production of income. Then therefore, entire foreign travelling is allowable deduction. If we have gone through what is the expense of foreign travelling, this is 7,570,000. Entire foreign travelling is allowable deduction. Foreign travelling expense, allowable deduction, section 11, subsection 1. This is a business tour. What is section 11? Incurred, any expenditure incurred for the production of income during the year of assessment other than capital nature, you can deduct. Okay. Then we will go for the next adjustment. The next one is provision for the impairment. Okay. Provision for the impairment is comprised of an amount of rupees 6,080,000 made for individual impairment for specific doubtful trade receivables, and the balance of rupees 10 million is for collective impairment. Now again, what I can say, even it is collective impairment, even it is individual impairment, the any kind of the impairment, impairment is a provision. That provision should be disallowed in arriving into business income. We will go for that part. This is provision for impairment. It's disallowed. Section 10, subsection 1b, Roman 8. Why? Irrespective of, this is additional note for you all. Irrespective of individual impairment or collective impairment or specified impairment, any provision it should be disallowed under section 10 1b Roman 8. Okay. Now the next part of it again, now we can go for the leasing allowance part of it. Company purchased 5 motor lorries with cool room under 5 years finance lease agreement made on, now in your paper it is given as 1st June 2018, that means it's under 2018-19 year of assessment. But instead of that I have changed it to 1st June 2017. Since it has given in here, if I have give the justification for this change, motor lorries finance lease, it has given 17-18, but here it's going to 18-19, therefore I have changed this. With a monthly lease rental of rupees 300,000 per each lorry. Then leasing allowance we need to compute for the lease agreement entered prior to 1st April 2018. Lease allowance on 5 motor lorries, lease agreement entered prior to 1st April 2018. This is given in the Transitional Provision Gazette. Lamai, I guess now you all having a solid knowledge on this Transitional Provision Gazette and what we have discussed in our revision session in the CA webinar. Now everything I guess now you all expert on these areas. Then 1/5 of lease value, it's given the 300,000 is the monthly rent, the 5 motor lorries, and it's for the 5 years, that means 60, 5 years means 5 into 12, 60 months. Then 1/5 of lease value, which is we need to take 5 motor lorries into 60 months into one installment 300,000 divided by 5, it's 18,000 or rather 18 million. Actual lease rentals paid during the year again, for the 5 lorries 300,000 into 12 into 5, then same amount. Then allowance of lease rental or allowable lease rental, which is allowable, the both are same, then this is allowance of 18 million we have provided. Done. Then what next? The bank overdraft, loan balances and the finance lease payable other than lease payable on 5 motor lorries mentioned under item above can be considered for tax purposes as at 31st March 2020 were 149,525. To refresh in your memory again, I am just taking a simple example, not actually simple example, just explanation. The lease agreements, and again we need to divide this to 2. Entered prior to 1st April 2018, entered on or after, 1st April 2018. Then for this part we are providing capital allowances. For this part, as the question as we have discussed, for this part of it we are providing leasing allowances, and the full finance cost is disallowed. And this finance cost we are not consider for what? Restriction under section 18. Not consider for restriction under section 18. Okay. This is additional part for you all. Now other than that lease rentals, it has given the what is the value of the borrowings. Why this has given? To check the thin capitalization or restriction under section 18. We will see what is this adjustment, finance cost. Step by step we will go for that finance cost, computation of disallowable finance cost. Then finance cost as per income statement, we will go for income statement and go for note of finance cost. Long term bank loan interest is there, short term bank loan interest is there, OD interest is there, finance lease interest of 5 motor lorries, we are not considered that part. Why? It should be disallowed in fully since the agreements entered prior to 1st April 2018. Then we will go for the answer. In that, in the note of the finance cost, I have extracted these things. Long term bank loan interest 5,420, short term bank loan interest overdraft. Finance lease interest on 5 lorries not applicable, treated under transitional provision. That means entire finance cost should be disallowed. Now total finance cost, the total of these amounts, it's 11,663. Total borrowings, how can I take this answer? 149,525. It has given in the question. Then we need to look at equity position. We need to look at the equity position. Equity position of the question, it has given in your pre-scene, the page number 6. Page number 6 of the pre-scene, it has given very clearly what is the stated capital and the reserves, all this information provided. Page number 6. Stated capital is the 999,950,000 and the revenue reserve is 1,843,789. There is a revaluation reserve of 105,616,000. Are you going to consider that? No, you are not going to consider that. Okay. Then what is this organization? This is manufacturing of dairy products. That means manufacturing entity. Therefore, what is the maximum borrowing time? Or to compute maximum borrowing time, what is is that 4 times or 3 times? It is 3 times. Then maximum borrowing limit as per section 18, stated capital plus reserves into 3 times, since the business of manufacturing 8,531,270. Now compare these two. What happened? Borrowing limit is more, we have borrowed less. Then please put your very explanation note. Excess of the borrowing than the maximum borrowing limit as per section 18, nothing. Disallowable finance cost, no disallowable finance cost, but there is a note. Since the actual borrowing limit is below the maximum borrowing limit, there is no disallowable finance cost. There is no disallowable finance cost. Okay, then I think that part is done. After that, we will go for the paper. We are in the last part of the adjustment of the paper. Then DPL has paid LKR 18,750,000 as self-assessment payment, which is our tax credit. Now we will go through paper one by one. What are the figures we have missed? I think note 1 we have considered all. Then revenue we have considered. Note 2 other income. 28 million considered, realization gain on quoted public company shares considered, dividend income, interest income from treasury bills, all these three should be eliminated from the business income. Why? These are part of the investment income. Dividend income net considered under section 7, it should be investment income. Fixed deposit interest income considered as investment income in section 7. Then treasury bill considered as the investment income. Now straight away I am going to investment income note. In that you can see in the interest income from fixed deposit, since it has given in the gross, I have taken it as it is. Then from treasury bills it's 68 million. Then after that dividend income, net dividend income, this is final withholding payment under section 88(1)(a). See my assumption, since I don't know in what period this has received, I put my assumption, assume that received before 1st January 2020. Why I have given this kind of assumption, because after 1st January 2020 there is no withholding tax on dividend, that is why. Okay. Then net dividend 14% and the gross dividend, which is given separately under separate note. But do not worry, these proposed changes are not testable with reference to this Inland Revenue Act, because nothing has legislated. Then next part, sundry income we have considered. The entire note 2 we have done. Note 3, salaries and wages, other than that staff allowances and PAY not deducted, we assume that all are allowable deduction. Then entertainment expense definitely disallow 15.9. It is very clearly given in the section 10 of the Act. In that 15.9 million entertainment expense disallow section 10 subsection 1b Roman 7. Then again the definition of entertainment expenses also given in the Act. Then next part of it, donation and gift 3,470,000 definitely should be disallowed. Why? It is not incurred for the production of income under section 11, and no information given on behalf of the donation. Is this is qualifying or not, we do not know. Then we should disallow this. Anyway, when arriving into business income, you should disallow the donation. Okay, 3,470. Done. And next expense category, fines and penalties 8,450,000. In that it should be disallowed. Fines, it's just given fines and penalties, and you have to put your assumption assumed paid to the government. It's section 10 subsection 1b3, it's very clearly given, penalties paid to the government. And if not, if such explanation is not given, you can put the assumption or else under section 11 subsection 1. That's mean our main deduction rule, this is a penalty and not incurred for the production of income, but for the safe way, if there is a penalties, if the particular definition, not the definition, description of the penalty is not given, please write, assume this is paid to the government. Okay. Next part of it, allowance paid to managerial staff, we have discussed it. Operating lease rentals on motor lorries, we have discussed. Provision for gratuity 14,150,000, it should be disallowed. In the early adjustment, we have allowed the gratuity payment. It is gratuity provision 14,150,000, its gratuity provision disallow section 10 subsection 1b Roman 8 under any provision. Next one, advertising. When analyzing the entire adjustment, we didn't find specific adjustment for the advertising, then we will put the normal thing which it is incurred under production of income. Advertising, assume that incurred for production of income, section 11 subsection 1. Okay. Then next one, depreciation. We have provided capital allowances for the all relevant asset, but we have not touched the depreciation. 37,775,000 should be disallowed under section 10. Depreciation disallowed, section 10 subsection 1b Roman 8. Done. Next one, amortization of intangible asset 3.5 million. Then in that amortization intangible, any amortization charged to P&L, it should be disallowed. For on behalf of that any amortization, there may be actual payments, that actual payments should be allowed. Any amortization, it should be disallowed. Then amortization of intangible asset, the brand name, we have given capital allowances and actual useful lifetime on it, and amortization, it should be disallowed under same provision in the depreciation section 10 subsection 1b Roman 8. Okay. Now any other adjustment we will see, anything we have missed? I think no, everything we have considered up to now. Everything we have considered. Yeah, other than this 18,750,000. Now we will compute what is the business income and what is the investment income and what is the total assessable income. Now I have taken the total of business income. It is the plus side, it is 456,963 and the minus 447,100. Then there is a business income of 9,863,000. This is my business income. Now I have put this common note, other than specifically mentioned adjustment, all other expenses and income considered as allowable for tax purposes. If it is income, it is part of the business income, and if it is the expense, it is allowable deduction. I think it's clear. Now business income we have done. Now we are going for our computation sheet. Like I have done in the pilot paper discussion, then I have not taken the much explanation on these things because we have done these things separately. Therefore, I have not taken much on that, but all the adjustment I have discussed with you all, but this format and all not much. Then business income 9,863 completed. Okay. Then investment income, all the adjustments we have considered, and from fixed deposit and treasury bills, the gross interest, anyway gross interest, treasury bill, no withholding tax anyway, from fixed deposit up to the 31st December 2019 there is 5%. After that proposed change, according to proposed changes, there is no withholding tax. It's for your information only. Then the total or entire investment income is 108,000. Entire investment income is 108,000. Done. Total assessable income from investment. Now we have done investment income. Other notes we have discussed. Investment income discussed, business income discussed. Now taxable income. Total assessable income is summation of investment income and the business income. We don't have other income part. Okay. Then qualifying payments and relief under section 52 and 5th Schedule Act, there is no such adjustment. The taxable income is same with the assessable income, therefore tax on taxable income, which is 28%, because this is manufacturing of dairy products. This is not the SME. We cannot take the concessionary tax rate of 14% under agriculture, then therefore it's 28%. Then total tax liability is 33,000,002. Then tax credit only one is very clearly given, quarterly installment payment we have adjusted, and fixed deposit. Now I have put my word in, again assumption. I don't know whether withholding tax deducted or not. Actually I don't know. The gross interest is given. What I have done, WHT 5% on FD interest 140. I have taken its gross interest is given, and I have put, assume that FD matured before 1st January 2020. Why? If the FD matured prior to 1st January 2020, the 5% WHT is definitely applicable. Then under that I have taken the tax credit, and total tax credit, total amount of the tax credit 20,750, and after that the balance income tax payable is 12,252,000. Okay, this is the end of the question paper. Not the end of the question paper, actually this is end of the section 2 question 3 part 1 for you. Okay, now since I have discussed this question, I need to add some part to this question, which is relevant for your the actual examination. In the actual examination, I am just summarizing, taking 5 minutes. In the actual examination, please go through this, since this is a company taxation, please go through all the allowable, disallowable adjustment starting from section 10 to section 19, which is main deductions and the main deduction rule, general deductions and specific deductions, and other than that, the finance lease adjustments and the bad debt write-off, section the 31, section 24, all these things what we have discussed, please go through. If you solid in that adjustment, this question is nothing to you. This question is nothing to you. The repair and improvements, capital allowances, then the restriction on finance cost, all these adjustments please go through before the examination. And I need to tell, plus now in the rest of the part I am going to discuss the tax planning and the business decision making. In that part also I am discussing how company is going to tax planning. Other than that I need to add for this the company taxation, please go through case law provisions, essential case law provision, transfer pricing adjustments and all the transfer pricing theory, section 76, section 77, case laws and this particular adjustment and the business decision making part of it, everything very important for your examination. Okay, then we will go for the writing part of the questions. Okay, now we will go for writing part of the question, the section 2 of the paper, the writing part. Section 2 of the paper, writing part is our main understanding we are going to do now. Okay, then here section 2. Okay, then questions and the question and answers we will look at one by one. Question 3, it is asking, now part 1 we have done. In part B, it is asking advice the senior management of DPL on the possible tax benefits including tax exemptions, qualifying payments and other tax benefits available under the provisions of the Inland Revenue Act number 24 of 2017 on each of the following proposals. There are 5 proposals, 1 to 5 proposals are there. In that each and everything, it has the marks allocated as 4 marks, then 4 marks into 5, it is 20 marks given for this part B. Okay. Now when it comes to this part, some answers are tested with the proposed changes, but don't worry, we will explain and we will understand one by one. Okay. Then first Roman 1 is asking, start an agro farm under DPL after purchasing a herd of 300 new cows for rupees 60 million in existing business premises to supply fresh milk without any change for school children. Okay, this is talking about starting an agro farm to with a new herd of cows and continuation of the existing business. This is to continuation for existing business to in the existing business premises to supply fresh milk without processing anything to supply fresh milk. Okay. Then for school children, this is the proposal given. Now we will go one by one with the answer. Our action verb, the examination requirement is advice. Then since it is advice, we need to look at what is this one and how we are going to write a good answer on this. Then mock paper, we are in a question 3 part B. It is tested 6 schedule temporary concessions, enhanced capital allowances. Then as well as in this question, it has tested proposed changes paper notice. I have taken it as an additional point since it is in the question. I have taken it as the additional point, which is to just for all of you to give a explanation on this, nothing other than that. What is the action verb or examiner requirement? It is the advice. It's in the evaluate level, that means tier 5, higher level. Then offer suggestions about the best course of action in a manner suited to the recipient. That means you should provide the advice, that means offer suggestions, best course of action. With the recommendation, you have to write a good answer. Then time allocation is 20 marks. That means 36 minutes if I have taken the 3-hour paper. What is your position? Again, you are tax consultant. We will go for the first part of the answer. Now it's asking, start an agro farm under DPL after purchasing a herd of 300 new cows for rupees 60 million in an existing business premises to supply fresh milk. Now the main concern of the examiner here to actually test the exemptions available for agro farming after proposed changes. Okay, but we will see a different angle in this question. Then actually before this question I need to explain this is now how you are going to analyze the question. In here the 300 new cows, it is investment is rupees 60 million, but as for the 6th schedule, or rather even if we have taken a second schedule to act, they are using the investment value in US dollars. And second one, this is cow. Cow is biological asset. And for in the section or schedule 2 and the schedule 6 is talking about investments in depreciable asset. That two things, even when reading this question, it should come to your mind. Okay, with that in mind, we will discuss with, as per information provided, company shall not benefit under second schedule or sixth schedule. Since I have discussed the answer format to all, then I am in pilot paper discussion, then I am doing this how student is write the question point, that's mean the exactly how you are going to write the answer for the given question. Okay. As per information provided, company shall not benefit under second schedule or sixth schedule since the requirements to fulfill to obtain enhanced capital allowances on investment incentives and temporary concessions are not satisfied. Why I am telling like that? Why? The investment going to made in LKR under sixth schedule and the second schedule, investment should be made in US dollars, and continuation of existing business, the milk, that's mean the producing milk, and not investing in depreciable asset. As I have explained previously, they are going to invest in biological asset. Biological assets are not covered in the scope of the Inland Revenue Act number 24 of 2017. Then further, company is not entitled to claim. This is actually an additional point for students. Now think, when you are writing your answer, that's a good part of this. Now when I am discussing paper, you all have done this paper. Then ask from yourself, check your answer, did I get these points? If not, you all having now today is the 7th, then for the examination, you all having pretty good period. Then please try to think like this. Okay. Then ask from yourself, did I capture these points from the question paper? Further, company is not entitled to claim capital allowance for herd of 300 new cows purchasing for rupees 60 million since biological assets has not been recognized as depreciable asset in 4th schedule to Inland Revenue Act. Under the depreciable asset definition, biological assets not covered. In the 4th schedule, biological assets not covered. Then this is a typical answer for this part, and I have given additional point, again not relevant to exam, but since this question has asked under that angle, I should discuss this part. However, as per proposed changes, the particular paper note is subject to formal amendments, company can grant exemption since the company start agro farm. That means without processing milk, they are selling the raw milk and plan to sell without any process or change. Hence, company can claim tax exemption introduced by government as per the proposed change with effective from 1st April 2019. That's what I have given separately, and the particular wording is the gain and profits earned or derived by any person from the sale of produce of an undertaking for agro farming of such person without subjecting such produce to any process of production or manufacture with effect from 1st April 2019. The with effect from 1st April 2019, as per the proposed change, this part agro farming is exempted. Okay. I think a very explanative answer is given, analyzing the current situation and analyzing the proposed change. Again, this is to show the picture of the question asked, but this additional point is not relevant for examination. Okay. Then we will go for the next part of the question, next 4 marks question. Installing high-tech machineries in existing business for processing to cater the increased demand for the company's dairy product by investing $3 million. Now you can see the $3 million. In which schedule you are having $3 million? 6th schedule, temporary concession schedule. Then in which assets they are going to invest? Machineries, high-tech machinery. High-tech machinery mean depreciable asset. Now you can very clearly apply 6th schedule of the Inland Revenue Act. Now we will see how you are going to apply that part. Installing high-tech machineries in existing business for processing to cater to increase in demand for the company's dairy products by investing $3 million. As per 6th schedule, temporary concessions of the Inland Revenue Act number 24 of 2017, a person who invests in Sri Lanka other than expansion of existing business on depreciable asset as prescribed in this schedule during the year of assessment shall be granted enhanced capital allowances computed in accordance with this schedule in addition to the capital allowances computed under 4th schedule. What is this? This is exactly the criteria to be satisfied to apply that investment incentive as per the 6th schedule of the Act. This is application of theory provision to understanding the applicable schedule. Now application for the given information. In this scenario, company is not entitled for any additional benefits such as enhanced capital allowance on investment for installing high-tech machinery at the investment of $3 million, since such investment is considered as expansion of existing business. See, it is very clear. Even in my question I have underlined that installing high-tech machinery in existing business. The dairy products manufacturing business, then you can't apply this enhanced capital allowances. But can you apply capital allowance on this? Yes, of course you can. However, company can entitle to claim capital allowances as for the 4th schedule to Inland Revenue Act number 24 of 2017 for installing of high-tech machinery for cost of $3 million. I think that is clear. Now see again answer format, the application of theoretical area and application that to given scenario, and again any additional point with the recommendation. Done. Then next question is asking next 4 marks question. It is asking on acquire the balance 30% of shares of Cather Limited. Now when analyzing the pre-scene in the presentation, we have seen that this DPL has acquired 70% of shares of Cather Limited. Then again the balance 30% is going to acquire. Why? To start an agro farm in order to purchase a herd of 300 new cows for 60 million rupees to supply fresh milk without any change for school children. Now not under the name of DPL but under the Cather Limited to start an agro farm. Now Cather Limited is, now you need to look at from the angle of the Cather Limited. Now in the Cather Limited, they are in the current business of the manufacturing of the cheese and butter, but with this the change they are going to do the supply of fresh milk. And can we apply the concessionary under the 2nd schedule or 6th schedule? No, we can't. Why? The investment is given in LKR, but it should be invested in the US dollars. And what is the item they are going to invest in? 300 new cows. It's a biological asset, not the depreciable asset. Okay. Then the answer for that part, as per information provided, Cheddar Limited shall not benefit under 2nd schedule or 6th schedule, since the requirement to fulfill to obtain enhanced capital allowances on investment incentives and temporary concessions are not satisfied. Investment going to made in LKR and not investing in depreciable asset. But their business is new undertaking. But even the business is new undertaking, we cannot go for the enhanced capital allowances. However, this is new business undertaking to the Cheddar Limited, since the company currently specialized in cheese and butter products. Okay. Further, company is not entitled to claim capital allowance for herd of 300 new cows purchasing for rupees 60 million, since biological asset has not been categorized under depreciable as the depreciable asset, as we have discussed. This again, this additional point I have put because this is the question, the angle is different, that is why I have put this again. From the proposed change, its agro farming is exempted. Therefore, if the company has invested in the fresh milk, the fresh milk thing, then it is actually agro farming, which is a raw milk. They are going to sell in raw milk without any processing. Therefore, they can grant exemption under proposed change, but this area is not subject to your examination. Okay. Then again, next question for you. Incorporate new isolated company to start an agro farm in order to purchase a herd of 300 new cows for rupees 60 million and install in high-tech machineries by investing $3 million in new business premises. Let me explain this hybrid version of this. Okay, let me explain this. We will go for the question. It is the DPL is going to incorporate an isolated company. Incorporation of isolated company. Isolated company, they are going to incorporate. This is the first part. And after that, they are going to start an agro farm. See this. What they are going to do is start an agro farming. They are going to start agro farm. After that, by purchasing, I am again using agro farm. Without cows, we cannot do that. Then acquiring a biological asset. Acquiring biological asset. Acquiring biological assets. They are going to do. The investment is, for this part, it's 60 million rupees. Rupees 60 million. Okay, done. Then they are going to install. Now, this is one part of this, and the next part, with this plus this investment, they are going to invest in machineries. Machineries, they are going to invest. Then in that, the installing high-tech machinery by investing $3 million. $3 million to invest new business premises in Badulla district, separate district. Then Badulla. Why this district has given? Can you remember? Now by analyzing this, you can see $3 million. Since this is $3 million, what is the schedule you can apply? It's 6 schedule you can apply. The second schedule to apply, it should be the more than $3 million the more than $3 million. Then Badulla, the investment shall be made other than the northern province. Then Badulla is other than the northern province. When reading the question slowly, you should analyze the question very well. Then Badulla district to supply fresh milk for school children. Now again this arrangement, the fresh milk to school children. Okay, this is the entire picture of the given question. Now we will go and we will see how you all going to write the answer for this kind of the question. Now DPL is going to start a new company in the Uva province, and in this new company using separate entity, what they are going to do, DPL is going to do the continue existing business operation together with selling of fresh milk without any process or change. Okay. Then as information provided for this part, agro farming part, biological asset for this investment, we cannot take any benefit. This is LKR and biological asset. Okay, we will go for that part of the answer. In this context, DPL plan to form new company in the geographical area of Uva province using separate entity from DPL in order to continue existing business operation together with selling of fresh milk without any process or change. They are going to continue the same business of the DPL but in the separate entity. As per the information provided, company shall not benefit under second schedule or sixth schedule for purchasing herd of 300 new cows for rupees 60 million, since the requirements to fulfill to obtain enhanced capital allowance on investment incentives and temporary concessions are not satisfied. The investment going to be made in LKR, continuation of existing business, and not investing in depreciable asset. Okay, then these are the main thing which we can do, but this is continuation of existing business in the context of the DPL. If they are having an isolated company, it is not the continuation of the existing business, it is under new company, they are going to do a new business. Okay, then the next part, now see how your answer is going to amalgamate under these two parts. However, with reference to investment in installing high-tech machinery by investing $3 million in new business premises, the company is entitled for enhanced capital allowance of 100% of investment as specified in subpara 2. Why? The separate company, the for new business, they are installing high-tech machinery, then it is satisfy the requirement of 6th schedule. See, in the same question, one part of the investment is not satisfying, second part of the investment is satisfying. Your answer should be fulfill both. Okay. Then business premises, the company is entitled for 100% of enhanced capital allowance as per the 6th schedule. And company is entitled to claim capital allowance. You cannot stop from here. You have to write this additional point. Why? This enhanced capital allowance plus normal capital allowances, you are eligible for this machinery. The normal capital allowances under 4th schedule, that also eligible, then that part you have to write. And company is entitled to claim capital allowances as per the 4th schedule to the Inland Revenue Act number 24 of 2017 for installing of high-tech machineries for cost of $3 million. Okay. Then last part of this, further company is not entitled to claim capital allowance for herd of 300 new cows purchasing for rupees 60 million since biological assets has not been categorized in 4th schedule to the Act. Okay. Other than the answer, I need you to think like this at the examination and analyze the question like this. Okay. Then additional point, again this is not relevant for the examination, that agro farming part is exempted, that part I have given separately. Selling fresh milk without any process or change, it is exempted as per proposed changes. Okay. Now we will go for next part of the question, which is last one. Incorporate new isolated company to start an agro farm in order to purchase a herd of 300 new cows for rupees 60 million and install high-tech machines by investing $3 million in new business premises in Ampara district to manufacture fresh milk and also processing to cater to the increase in demand of dairy products. Then this is again the same analysis in the fourth question we have done, the fourth part of the question, then same answer. It is there. Then this also, since this is other than Northern Province, same answer as per above 4 is applicable. Okay. I think with this the mock paper discussion and as well as the pilot paper discussion, these both parts are the understanding to the 6th schedule, you all now in a good position. But let me add for this part, for your now this actually business decision making part, other than that, for the actual examination, this the 6th schedule, 2nd schedule, specific deductions, main deductions, case law provisions, transfer pricing, and all these things, the combinedly test in this 50 marks question. Then therefore, please go through all that part and practice that questions too before the actual examination. Okay. Then we will go for the next writing part of the section 3. Actually, the thing is, this is again entire 5 marks is from the proposed changes. This part is not relevant for your examination, but I thought for the since the question has asked and it's for the tax administration part, this type of questions are very important. Then I am discussing with this you all. We will go for the question. Okay, this is entirely from the proposed change. I am again repeating, but for your benefit I will discuss this part. We will see what is the question and what is the requirement. Okay, question. The filing date of the annual income tax return for year of assessment 1920 will be on 30th November 2020, where it has taken in the section 93. I am again going with you all for tax administration part. The section, as per section 93, any person who registered for income tax shall file income tax return within 8 months after end of the year of assessment. Okay, then that has quoted, and due to the impact of COVID-19, most of the stakeholders in taxation requested from the government to extend the income tax return filing date. Okay, it's practically happened. By following the instructions of the Ministry of Finance, the Department of Inland Revenue made the following notice to the taxpayers. What is this notice? We will see this notice. This is the notice. furnishing return of income tax for the year of assessment 1920. See the notice, we will read this. According to the provisions of the Inland Revenue Act number 24 of 2017, every person who is liable for income tax shall file a return of income not later than 8 months after the end of each year of assessment. Therefore, last date to furnish the return of income for the year of assessment 1920 is 30th November 2020. Yes, that's true as per section 93. However, the prevailing COVID-19 pandemic situation of the country may cause difficulties to taxpayers and approved accountants for furnishing return of income as per aforesaid statutory requirement. We are in the difficulties to do that. That's also correct. Taking into consideration such reasonable difficulties, taxpayers and approved accountants are informed that penalties for failure to file a return on time as provided in IR Act will not be imposed where the return of income for the year of assessment 1920 is furnished on or before February 28, 2021. This is the notice which is issued by Commissioner General of Inland Revenue. This is the notice. Now, according to the notice we have looked at, now we will see what is the question. In any person has submitted his income tax return for the year of assessment 1920 between November 30th, 2020 and February 28, 2021 as per the paper notice. Explain whether the return is filed on the due date or not. That is asking even the return has filed on or before 28th February 2021 as per the provision of the paper notice, as per the given in the paper notice, can it be the return filed on or before due date? Okay. Not explain whether the return is filed on the due date or not with reference to the relevant provisions of the IRD Act number 24 of 2017 applicable for the time bar rule. What the examiner is asking about the time bar rule. Let me ask a question. What is the time bar rule? The time bar rule is we are having 4 types of assessment: self-assessments, default assessment, advance assessment, amended or additional assessment. In section 135, if I am not mistakenly, very clearly given what is the time bar provision for the self-assessment, particular kind of a self-assessment. This is, we are talking about the extending of time period for self-assessment tax return, which the taxpayer in his own assess the tax liability and he has filed the return. Then this is self-assessment tax return. Therefore, asking, okay, the time bar provision is 30 months from the date of filing the return. Is it applicable? Now, penal provision is not there. It's in the paper notice itself very clearly. Now, we will see the answer. How to write? Now, even this is not relevant for your examination since this is not legislated. Why I have taken this? I need to explain the procedure of writing. Okay. Now, we will go for that part. How you all going to write the answer? How you all going to write the answer for this kind of question? Even this kind of question is not tested in the actual paper. Anyway, you have to write answers for the tax administration questions. Okay. Now see, the examiner is very clearly asking what is the applicable for the time bar rule. Without knowing the time bar rule, it's difficult. Now, first one, theoretical part, you have to write time bar rule. Time bar rule you have to write, and this is the first part. And the second part, in the paper notice, it has given the time has extended to 28th February. Then the second part of this, you have to think, can CGIR do that? Can CGIR do that as the extension of time? Can say, or CGIR has power to do this. Yes, this is one part of your answer, and this is second part. Yes, CGIR has in section 130, extension of time to file the return, section 130. And the third part of this, there is a provision, there is a time bar rule, and we have to file the return on 30th November. With all these circumstances, by adding these two, time bar provision is if we are going to comply with the time bar provision or not, which is your recommendation. This is your answer format. Okay, then we will see how we are going to write the answer, and this is a writing part of the question of the tax administration. I am highly recommend you to use the maximum benefit of the open book referential. Okay, use the act, use the relevant provision, and write a good solid answer. We will go for the answer. As per section 93, return of income, subsection 1, every person should file with the Commissioner General not later than 8 months after the end of each year of assessment a return of income for the year, that means in the year of assessment ended 31st March, the return of income shall be filed on or before 30th November of subsequent year of assessment. Done. Next one, however, as per section 130, what is the section 130? Extension of time to file returns. The Commissioner General may extend the time limit specified for filing a return where the taxpayer or other person required to file the return applies for the extension by due date. The such kind of spectacle situation has happened. Now there is a provision in the law for that. Then the granting of an extension of time under above para shall not affect the due date for payment of tax unless an extension of time for payment is also expressly granted. Now payment, what is the due dates of payment? If we have taken 2019-20 year of assessment, it's the 4 quarterly installment payments and 1 final payment is there. The quarterly installment payment for April, May, June, you should make the payment on or before 15th August the 2019, and for July, August, September quarter on or before 15th November 2019, and October, November, December quarter, it is 15th on or before 15th February 2020, and for the 4th quarter on or before 15th May 2020, which is the coming to subsequent year of assessment. Then final payment on or before 30th September 2020. Then that payment procedure not affected by this. And we need to discuss about the time bar rule. As per section 135 subsection 2b, the time bar provision for a self-assessment is within 30 months of the date that the self-assessment taxpayer filed the self-assessment tax return, which the self-assessment relates. Now under section 130, Commissioner General has extended the period. We have filed the return within that extended period. From the date of return filed, the time bar is starting, therefore no impact to the time bar rule. Therefore, time bar rule for making assessment as per the provision of Inland Revenue Act remain unchanged and no effect from notice of PNIT 2020-09. Okay. I think even this is not relevant. I have discussed the answer format. Then that is repression of your the writing part of the question. Okay, now this is the end of the discussion of section 2, question 3. The entire question of the I may say it's unseen part of the paper, and again I am repeating the entire syllabus of tax can be test with this 50 marks part for the small questions. Therefore, all the adjustments relevant to company taxation, the advantage of 4th schedule, 5th schedule, 3rd schedule, 6th and the 1st schedule with reference to tax rates, please take. And for this 50 marks part, case law provisions, it's compulsory. Please go through all the case laws and the Patrice, the how to write the answers and transfer pricing part, and the typical adjustment relevant to company taxation and tax planning, this kind of tax planning and the business decision making from any it may be specific adjustments, maybe the particular schedules. Likewise, please go through before your actual examination. Okay, then we will go for the section 1 of the mock paper discussion now, the question number 1 and question number 2. In there also I am starting from question number 2. Okay.